What are we going to cover? We're going to cover, number one, the fundraising landscape. So looking at what are some of the options that are out there. I know in Silicon Valley, in the Bay Area, venture capital really dominates the conversation, but we want to at least touch on some other aspects of how you might be able to get funding. And then, the main topic, which I feel like probably most of you are here for, venture capital, right? Understanding a little bit more about that. And then preparing for funding. In this one, we're not going to talk so much about, hey, here's the step-by-step analysis that you need to take in order for you to get like, hey, how do I structure my pitch? How do I strategize for talking to investors? How do I find the people who are, the right folks that are going to be a great fit for me? We're not really going to talk about that so much. We're going to talk about more is some of the operational side of what are the steps that you can do to get your company ready to receive the funds that a venture capital firm or another investor might provide to you. And then the last one is finance and accounting fundamentals. So for this, we really want to make sure that you guys have the tools in your tool belt to be able to speak intelligently when you're asked questions about finance and accounting that are surely going to come when you are having those discussions with potential investors. So what are the objectives here? Number one, just want to give you a better understanding of the venture ecosystem, know some of the alternatives to VC funding. One of the big things that I really want you to get out of this is thinking about the outcome that you want, right? I feel like a lot of folks maybe get caught up in, oh, here's what this person did, here's what that person did, and I need to do exactly what they did in order to be successful. And that's not always the case, right? And it is your life, right? You want to make sure that you're doing something that aligns with your desires, something that aligns with your values and aligns with the outcome that you want. Next, we want to understand some of the key finance and accounting concepts. And then hopefully you guys can take away a list of action items that you can implement as soon as today. So with that, let's start with the fundraising landscape. First thing, dilutive versus non-dilutive. Has anyone heard of this? So dilutive funding dilutes or reduces your ownership percentage in your company. In other words, you're going to be selling a part of the equity or part of the ownership in the company. So non-dilutive versus dilutive. So non-dilutive, you're not giving away equity, you're not losing ownership. What are some of the options there? Well, we have self-funding and bootstrapping or debt/loans. And this isn't necessarily a comprehensive list, but we want to hit the highlights here. So what does it mean to self-fund or bootstrap? Real simply, this means that you are funding the operations and funding the growth from the profits of your business. And then using debt or loans as non-dilutive funding, right? I think this is pretty self-explanatory, right? If you get a loan from the bank or from somewhere else, what's going to happen? Well, you don't give up any ownership for that typically. However, you are going to have to pay back the loan amount as well as whatever interest rate is attached to that loan. So next is dilutive. So we're going to talk about first where those dilutive funds might come from. So first, just classic family and friends, right? There's a really, really great story with, there was a guy really passionate about wanting to start a startup, and he went and talked to a bunch of people, including family members. He talked to his mom, and he's like, hey, mom, look, I really want to do this. Most likely it's going to fail. And if you invest in this, probably your investment is going to go to zero. But if you understand the risks and you're willing to support me, that would mean a lot to me. She ended up investing $250,000. And fortunately for her, her son was Jeff Bezos. The company was Amazon. And so suffice to say, she did pretty well on that. So in this case, the moral of the story is sometimes it works out. However, I think it's really, really important to consider what Jeff Bezos said here, which is that the most likely outcome is that this investment will go to zero. And so when you're talking to people who are not professional investors, who are not even sophisticated investors, right? When you're talking to those family and friends, it's really important to make sure that they understand the risks and that the most likely outcome is that their investment is going to go to zero before they invest. Next, angel investors. So this is a unique group of folks, high net worth individuals. They invest in startups with their own money. They're not professional investors, but they are sophisticated investors, right? So this is something that they typically have a history of doing. One of the things that's important to note about them is because they're investing their own money and they're not professional investors, they're going to be a little bit more flexible typically than venture capital firms. They might be willing to take more risks. They might be interested in funding you just because, hey, they really like you as a founder. It's just a little bit of a different dynamic from venture capital. And one of the things that's important to note about angel investors, the amounts that they're going to invest are typically smaller because they're investing their own money. And so typically where you will see those angel investors is really in the early stages of a company, not so much later on. The next is venture capital. We're not going to take a deep dive right here, but one thing I want to call out is that it's venture capitalists, not venture philanthropists, right? So these folks who are giving money, they're not giving it away because they're altruists, right? They're giving it in expectation of getting a return on their investment, right? So it's important to keep in mind. One other thing that we have here for dilutive, this isn't necessarily it's not necessarily very applicable to early stage startups. These focus a little bit more on mature companies, but I figured I'd throw it out there just as an FYI. Hedge funds, private equity, family offices, things like that. All right. So we talked about where that dilutive funding could come from. Now let's take a look at the forms that it could take. We have the idea of a priced round versus an unpriced round. Does anyone have any sense of what this means to have a priced round versus an unpriced round? I will take that as a no. Okay, so a priced round simply means that if I sell you 1,000 shares in my company for $1,000 a piece, that implies a price of $1 per share, right? So that's just, hey, I'm selling equity, I'm selling ownership of my company, I'm selling shares in my company. It's a very simple transaction. For an unpriced round, typically what this means is that you have what's called a safe. And a safe is a simple agreement for future equity. This is a very, very simplified document that was put together by Y Combinator to make it really easy for early stage startups, especially, to raise money. So what you're doing is you're not actually selling shares in your company. You are selling the ability for people to potentially get shares in your company if certain triggers happen in the future. And the benefit to this is that it allows you as a startup founder to have a term sheet that's maybe 5 or 10 pages long instead of 50 to 100 pages long. And it also allows you to more effectively maintain control early on when the startup is going. There's another thing that we want to talk about just real briefly is called convertible notes, right? So we talked about selling equity directly. Hey, here's a share, $1 per share. Here's a safe. You don't really have a price attached to it, but you say, hey, you can have the potential to own these many shares in the company or this percentage of the company in the future based on if you provide this much money and all these things happen. But the convertible note is the idea that someone gives you debt, right? Someone gives you a loan. And what they say is, well, I really like the prospects that you have as a company. And rather than just collecting the interest and the principal repayments on this loan, I'd like to have the option to turn this into shares in your company, at which time you would no longer have to pay back any of the loan. And so that's another option that you have out there. Those, I think, are a little bit less common than they used to be, but do want you to be aware of what a convertible note is. Oh, and there is we've got about one other thing here. Um, there are some options outside of the dilutive and non-dilutive that I just described. These are often going to be sort of one-off type of things, a little bit more unique arrangements, high amounts of customization. What what could those be? You could have some kind of strategic partnership, some kind of joint venture. You could get some kind of grant, maybe from a competition, maybe like National Science Foundation. There's also government development funds as well. We're not really going to dive into those, but again, just want to make you aware that those are out there. All right, moving on. Venture capital. So here's the first question for you all. What is a VC firm? Who thinks they know what a VC firm is? No one knows what a VC firm is.
I can try.
Perfect, please.
Yeah, so a venture capital firm is a fund or a firm which collects money essentially from what we call limited partners and invests in investment which is riskier. So their risk appetite is high. Their usual thesis is that they want to they want to have a few unicorns among uh, all the portfolio that they have, and they that's why they invest in startups.
Beautifully said. Thank you so much for that. That's great. Your definition might even have been better than mine. So here's my definition. It is a type of investment company that manages pools of money, which are called funds, for people and or organizations with deep pockets and invests that money on their behalf for a certain period of time in order to generate a return on investment for those people and or organizations. So another way to say this, and I think you said it very well just a moment ago, they buy ownership stakes in startups with high risk appetite so that they can sell them later at a higher price. Hopefully, like you said, they have some unicorns and some nice exits, and they can get a healthy return to their investors, those organizations, those people with deep pockets, who are called limited partners. So, what are the implications of what we've just described? So, as was mentioned, the VCs don't just need to make money for themselves, they have their own investors. Those limited partners, they're beholden to them. They have to generate good returns to those limited partners consistently in order for the VC firm to stay in business and to grow. Additionally, as was mentioned, the investors don't invest in the VC firm. They invest in the funds, those pools of capital that the VC firm sets up. And so VCs are judged on the performance of each fund. Especially, you're going to see this for smaller or younger VC firms that have less of a track record or less of a name brand, right? If you're not an Andreessen Horowitz, if you're not a Sequoia, if you're not a Kleiner Perkins, right, you need to make sure that you're consistently delivering really great returns for your limited partners so that hopefully one day you can end up like one of those big guys.
Yes, because you are not the wrong.
All right. So, what is the VC firm investment strategy? Let's take a look here. So, the VC firm is going to use the money that's in the specific fund that they're investing from. They're going to make a limited number of investments per that fund. That can vary from firm to firm. Might be 20, might be 40, might be 50, might be something else. The expectation is the majority of the investments are going to lose all their value. It's all going to go to zero. A couple of the investments might break even. And then typically there's one investment that provides the entire return for that fund. So let's look at an example of this. So let's say we have a $100 million fund. So that's how much assets are under management by the VC firm in that fund. The fund has the typical 2 and 20 fee structure, 10-year life, and the expectation is that they're going to have a $500 million ending value for this fund. So with a 2 and 20 fee structure, they're going to take 2% management fee on that $100 million dollars every year for 10 years, $20 million dollars off the top, gone. That means they have $80 million dollars to invest over 20 investments. So what's going to happen? $4 million dollars each in those 20 investments. 19 of them are going to go to zero. And we're going to use a little bit more simplified math here. We're just going to say all of them except the one go to zero. So that's $76 million dollars just gone. $4 million dollars left. This one, in order to achieve the $500 million dollars ending value, that's going to need to get 125x growth in order to return the fund, right? So we have $420 million dollars going back to the investors, another $80 million dollars going to the VC firm based on their 20% carry. So what that means is that over the course of 10 years, the investors in the VC firm, the limited partners, they got $420 million dollars back, roughly 15% IRR, and that was all delivered by that single investment. And this is going to be really important. We're going to come back to that in a little bit. So now you know a little bit about the investment strategy of VC firms. Let's say you're talking to a VC firm. What are some questions for you to ask? Well, you can ask them, what's your investment thesis, right? Maybe they only invest in deep tech and you're working on something in the consumer space. That's probably not going to be a great fit. You can ask them, what fund are you on, right? Is this a VC firm that's only been around for a couple of years and they're on fund one? Is it a VC firm that's been around for 10, 15, 20 years and they're on fund four, five, or six, right? That's going to be really important to understand. It's also going to be important to understand what's the fund size. So if you're going to be the one investment that returns the entire fund, right? If it's a $1 billion fund, they're probably going to want to see that you have a multi-billion dollar outcome for your startup, right? That's going to be a lot different than if you are being invested in by a firm with $100 million. Maybe they only want a $500 million outcome. So keep that in mind. Another thing to just ask them is, hey, what percentage of this is deployed, right? Good to know kind of where they're at. Understand what's their typical investment look like. The startup, the founder profile, what kind of check size do they typically like to write? Is it $100,000? Is it $1 million? Do they like to lead the round? Do they like to be a follow-on investor? Do they like to invest in seed rounds? Do they like to invest in Series A? What's their bread and butter? But if we just go back to this real quickly, if you take a look at this $100 million fund with 2 and 20 fees, how does a VC firm make money? It's on their fee structure. So the typical fee structure is 2% of the assets under management and 20% carry. So what does that mean? That means on a $100 million fund, every year they get 2% of the assets under management as their management fee. So they would receive $2 million every year over the course of that 10-year life. So at the end, they would have received $20 million in management fees, right? So that's their fee for doing all the work of going and picking the investments, running all the operations of the firm, all that stuff. And then the 20%, basically that's a percentage of profits, right? So if you have a fund that's $100 million and it ends with 500 million, well, you have $400 million in profits. So typically a VC firm will take 20% of those profits. That's why in this illustration, you're seeing that $400 million times 20%, which is $80 million, goes to the VC firm. So in this scenario, with a $100 million fund and a 4x to the investors, or we'll call it a 5x of the fund, the firm makes $100 million. Does that help? Oh, okay. So we were talking about what does a typical investment look like for the VC firm, and then we want to see, how do they work with startups, right? What are their expectations for oversight, for governance? What kind of level of involvement do they want to have with that? Are they constantly going to be bugging you, right? They say, hey, where's the numbers for this month? or are they going to be more hands off? You want to get a sense of what that's going to look like. And the last question, of course, this is not an exhaustive list, but it's some questions that are good to ask. What other support do you have for founders, right? Because any VC firm can give you money, and any dollar is the same as any other dollar. So, what are sort of the extra things that you might be able to provide as an additional value beyond just the money? So, that's what, on your side, questions that you should be asking. Some of the stuff that you're going to be asked, right? Table stakes, you're going to be asked to give your pitch, right? Um, I think everyone knows that. You want to have a good pitch, have it ready to go. You want to make sure that you understand your audience and that you're talking to people who hopefully are the decision makers. That's always important to be sure of. So this next one, are you the one investment that goes to 125x? They're not going to ask you this directly, but this is the thing that's going to be on their mind as they discuss with you and understand what, the addressable market is for what it is that you're doing. What else? You want to demonstrate that you have traction and growth. They're going to say, hey, how's it going? Tell us about what your growth rate is. What kind of traction do you have with your customers? You want to avoid vanity metrics. A vanity metric is the idea that you have a number that maybe sounds nice or sounds fancy, but doesn't really have any demonstrable value in showing that, hey, you are achieving what you want to achieve in terms of your traction, in terms of your growth, in terms of your ability to be that one investment that provides a 125x return. And then if you do get through all that and they say, hey, we really like you, let's get to formal due diligence. They're going to ask you for access to your data room. And in your data room, of course, talk with your advisors, but typically what you'll want to have in there is your pitch deck, articles of incorporation, the corporate bylaws, a copy of your cap table, any major legal documents, historical financial statements, balance sheets, P&Ls, cash flow, and potentially financial models, projections, stuff that's forward-looking, in addition to those historical financial statements that are going to be more backward-looking. So let's say you understand the venture capital ecosystem, you understand how VC firms work, you've been talking to them, you asked your questions, they asked you their questions, you gave your pitch, you went through formal due diligence. What happens next? You're going to hear no a lot. Now, part of that might be what we call a soft no or a silent no, which is that they just never get back to you, right? But one of the things about being a startup founder is that you will face a lot of rejection. You are going to hear no a lot. And one of the things that my co-founder, Stephen Torres, liked to say when he was teaching at UC Berkeley, and now when he's coaching startups, I love this. And so, Stephen, thank you for letting me borrow this if you're listening. Number one, it's going to be harder than you think. It's going to take longer than you think, and it's going to cost more than you think. And one of the things to really keep in mind is that if you let that phrase soak in and you understand it, and you say, I am okay with that, you're probably cut out to be a startup founder. If you take a look at that and you say, I don't know if that's for me, that sounds like a lot of work, that sounds like a lot of heartache, that sounds like a lot of headache, you might want to consider whether or not being a startup founder is for you. So you're going to hear a lot of no answers, but hopefully you hear some yes answers as well. And as I mentioned before, keep in mind that dollars are fungible, which is to say that $1 is the same as the next dollar. And it's going to be really important for you to find the right fit. If you're going to be accepting money from a VC firm, it's not the same as like, oh, we're just going to go on a date together. This is the equivalent of getting married, right? This is something that's not very easy to undo. In fact, it's probably more difficult to undo than a marriage. So it's going to be really important for you to find someone who understands your space, right? Who believes in what you're doing, who shares your vision, and has confidence in your ability to achieve that vision, right? So those are all going to be things that are really, really important to keep in mind as you've got term sheets lined up and you're making a decision. Okay, so now we've talked about funding types. Let's talk about how to prepare for funding. And again, I think I mentioned this at the outset. Um, what we're not going to do is talk about all the different step-by-step details on how to craft a pitch or identify potential investors or all of that. It's going to be a little bit more operational here. So first thing, know what you want, right? What kind of outcome do you want for your business? What kind of ownership or decision-making ability do you want to maintain? Um, is this something where you say, yeah, I can see myself doing this for the next 5 to 10 years? Or is this something like, this is my life's calling and I'm going to be doing this as long as I live, right? Um, Thinking about what kind of funding needs you might have, right? Do you need dilutive funding right away? Can you bootstrap it for a while until you feel like you have enough traction that allows you to get a favorable fundraising terms? One other thing to keep in mind is the concept of a one-way door versus a two-way door. I think it was Jeff Bezos who kind of popularized this, where the idea of a one-way door is a decision that you make that is not very easily or sometimes very nearly impossible to undo. Whereas a two-way door is something where once you make that decision, it's relatively easy to undo it. And going back to what I was saying before with once you take VC money, that's almost it's almost more difficult to dissolve than a marriage. That is very much a one-way door. And once you take it, you're going to be expected to pursue a VC style outcome, fast growth, high dollar value exit, and a trajectory to be that one investment in the fund that returns that 125x. So next thing, highlights from Ellerra's startup checklist. Has anyone watched the show Silicon Valley? Show of hands. Okay, we've got a few. Perfect. So uh, it's funny. They're able to bring to light a lot of the quirks of Silicon Valley in a very humorous way. There was a great scene in one of the early episodes where Pied Piper has just received their first investment check, and so they go to the bank. They're all excited, like, "Hey, I got this investment for my startup, and we're going to do great things." And he goes to tell her, and she says, "Oh, I can't deposit this yet." And he's like, "Why not? This is a good check." She says, "Well, you're not an actual registered company yet." So what we want to do is help you get some of that organizational stuff in place so that this doesn't happen to you. And if Pied Piper was a client of Ellerra, here's what I would have told them. So we've got 3 highlights from Ellerra's startup checklist. Number 1, determine the best legal structure, incorporate based on that, and then once you have that, get all of your corporate legal documents in place. Number 2, set up a business bank account. It's going to be really important to make sure that you do not have commingling of personal funds and business funds. Number 3, get QuickBooks Online or something similar. There's other places out there like Xero that are good as well. But the idea here is that you need somewhere where all your financial data is going to reside, all of those transactions that you have coming from your bank, all of those transactions that you have coming from your corporate credit card. You want all those to be housed in one repository, which can then be used to generate the financial statements for your company. One thing I will recommend, you really should get some professional help in setting this up and managing it. We see a lot of folks who try to do it on their own. And what happens more often than not is that they come to us and say, "Hey, I tried to do this myself. And, I tried to do it for 6 months. And now I have my investor asking for financials. And I just can't figure out how to get financials that make sense." In fact, about an hour before this presentation, I had one of my clients call me, and he said, "Stephen, I've got this investor. He wants to get a P&L and a balance sheet for the first 2 quarters of the year. I just spent 2 hours trying to run this from QuickBooks. What's going on? And can you help me?" Anyways, after a 15-minute call, we were able to get the financials that he needed. over to the investor, and the whole thing was taken care of. And he sent me a quick note afterwards. He said, "Hey man, thank you so much for taking care of this. I can't believe that something that took me 2 hours, we were able to resolve in only 15 minutes with your help." So again, lean into the fact that having a professional is going to help you in setting that up and managing it. Um, a couple things to kind of keep in mind here. At least one of the questions I would ask if I was in your place. Well, when do I need to have this in place? I would say as soon as you start incurring business expenses, you should be looking to make sure that you have the corporate structure, the banking infrastructure, and the financial reporting infrastructure, at least the basic setup, so you can capture that data and be able to report it out to your potential investors. Note number two. So this is something that's specific for the folks in California. Starting on 12/31/2025, the state has mandated that all companies with one employee or more must offer retirement benefits. So if anyone is on the call and you already have your corporate entity set up and you have at least one employee, please look into that. That's going to be really important that you maintain compliance with this new mandate from the state of California. And then we've just covered 3 highlights from the startup checklist here. If you'd like to get the full copy of our Ellerra startup checklist, please feel free to send me an email. It's right there on the screen, info@ellerra.com, and we'll be happy to send that your way. Okay, so continuing to move on, finance and accounting fundamentals. I'm going to steal another thing from my business partner, my co-founder, Stephen Torres. Again, when he was teaching at UC Berkeley, one of the things that he always used to tell his students, there's 2 things that you need to get the absolute best of if you're a startup founder. One is attorneys, and the other is accountants. Almost anything else you can go cheap on. But if you get the accountants and the lawyers who are good, that's going to save you a tremendous amount of headache down the line, and it's worth it to start off on day one with having good accountants and having good attorneys. So just throwing that out there. Okay, so finance and accounting fundamentals. The unified finance stack, this is something that we like to talk about at Ellerra. This is the combination of technology, people, and processes that are going to allow you to take raw inputs, transactional data, whether it's from your bank, from your credit card, from somewhere else, and be able to turn that into accurate financials that are going to be beneficial for your investors and are going to be insightful for you as the owner of the company, as the founder of your startup. So what does that mean? So let's say you just get technology, right? You say, "Oh, I'm going to get QuickBooks." And we've had people come up to us and say this like, "Oh, well, I bought this QuickBooks subscription and I thought that just automatically generated all of my financial statements for my investors." Well, no, that's not the case. You still need people to operate the software. However, for number 2, people, you can't just throw anyone at this problem, right? Like, "Oh, hey, my brother's cousin's niece's babysitter is going to be helping us with this." It's probably not going to work. You're going to want someone who is, again, a professional. You're going to want someone who understands your business. And then when you have someone who can do that, they can put in processes in place so that you have a good accounting functionality to be able to have systems that are scalable and that grow with you as you achieve the success that you want to achieve. So next is financial statements. One thing to keep in mind about financial statements is that they are backwards looking. So we have a balance sheet, a profit and loss, and a statement of cash flows. So what do those 3 do? Well, a balance sheet tells you what your assets and your liabilities are at a single point in time, right? It's showing the balances of your assets and your liabilities at a single point in time. Your profit and loss, also known as your income statement, shows the activity of the company, your revenues, your expenses, etc., over a period of time. And then the statement of cash flows, I feel like doesn't get a whole lot of love within the startup community, but I want to put it on here just to make sure that people are aware of it. So there's two kinds of accounting: accrual accounting and cash accounting. You don't have to know the intricacies of how they're different. Um, if you are going on cash accounting, your statement of cash flows and your profit and loss are going to be the same thing, and therefore the statement of cash flows more or less becomes irrelevant. Um, if, however, you are doing accrual basis accounting, which is what publicly traded companies use, this is the sort of standard, generally accepted accounting principles. Um, then there are going to be distinctions and differences between what your profit and loss says and what your statement of cash flows says. And the statement of cash flows in this scenario helps you understand, hey, where's my cash gone? All right. So here's an example of a balance sheet. So you can see we have assets and we have liabilities and we have equity. And each of those is presented in the order of liquidity. So we have cash, we have other assets such as accounts receivable, other current assets such as prepaids, and then for liabilities, accounts payable, credit cards, any kind of debt that you might have. And then you have your equity, the investments that you've taken from outside investors, the investments that you've made yourself, as well as any net income or retained earnings. And then the profit and loss. Again, this shows the activity over time, the revenues that you have, the cost of goods sold that's associated with delivering those revenues, and then the expenses that you have on more of an overhead basis, salaries and wages, your travel and entertainment, outside services, sales and marketing, things like that. Okay. All right. So a few more things. Number one is the financial model. So we talked about how the financial statements are backward looking. If you have a financial model, this is going to be forward looking, right? This is going to be projecting out what you expect to come in the future. And this is going to be really important when you're talking to potential investors to be able to have something like this. And it's not that it has to be perfect, but you want to be able to have assumptions and calculations that are defensible and show that you understand your business, you understand the market, and you have a good sense of what the opportunity is, and that you're critically thinking about all of these together in a way that allows you to say, hey, here's an intelligent guess on how things might play out. It's never going to be exactly how you put in your model, but again, it's a great thought exercise, and it really shows investors that you're thinking seriously about the opportunity at hand. And then the last thing is just some taxes, things to watch out for. Your franchise tax, your income tax, your sales tax, and then there's other taxes as well that we're not going to go into. But I know a hot topic right now is tariffs, which is a form of taxes. So these are all aspects that are part of the fundamentals of accounting and finance that hopefully are going to be able to allow you to speak intelligently and confidently when you speak with potential investors.